Welcome to this explainer. Today, we're taking a magnifying glass to Ballard Power Systems Q2 2026 financial results. We're unpacking what is usually a pretty dense financial report to reveal something way bigger, a massive structural strategic pivot for the entire company. Look, if you follow the hydrogen ecosystem, you already know Ballard is a total staple in fuel cell tech. But what they just announced this quarter, it literally changes their entire trajectory.
Let's dive right in with a powerful statement straight from the top. CEO Marty Neese is calling this quarter a transformative milestone, pointing directly to their new agreement to acquire a company called GeoPura. Now, when a CEO throws around the word transformative in an earnings report, we definitely need to pay attention, right? He clearly sees this as a defining moment for Ballard's future.
And that milestone is anchored by a truly staggering number, a 275 million British pound upfront agreement to acquire GeoPura. This isn't just some small incremental step. We're talking about a massive financial commitment engineered to rapidly alter Ballard's position in the global energy market.
To help us digest this efficiently, here is our roadmap for today. 1. The GeoPura acquisition. 2. Q2 2026 financial highlights. 3. Breaking down the revenue. 4. The path to profitability. And 5. Looking ahead to 2026.
Section 1. The GeoPura acquisition.
Historically, Ballard has primarily been in the business of selling zero-emission PEM fuel cells, essentially the core engines for buses and trucks. But bringing GeoPura into the fold sets Ballard up under a totally new framework, an energy-as-a-service model. They're going to be utilizing hydrogen gensets, which are basically mobile power generators, and leasing them out. So it's a fundamental shift from just selling hardware to selling the ongoing provision of power itself. This strategic pivot is specifically designed to expand their reach into the highly competitive off-grid alternative power market. But more importantly, it strengthens Ballard's revenue visibility. By leasing these hydrogen gensets, they drastically increase their exposure to recurring service-based revenues, which is a game changer because it smooths out those notoriously lumpy sales cycles you get with heavy-duty hardware. Section 2. Q2 2026 financial highlights. The absolute crucial point here is a massive 28-point improvement in gross margin. They literally flipped from a negative 8% gross margin in Q2 of last year to a very healthy positive 20% this quarter. That makes 4 consecutive quarters of positive improving gross margins. For a hardware-heavy tech company, a swing like that is absolutely monumental.
So, how do they pull it off? Well, they achieved this through incredibly disciplined commercial execution and specific product cost reduction initiatives. Plus, they benefited from lower manufacturing overhead thanks to a global restructuring they kicked off back in July of 2025. On top of that, their fuel cells are proving to be much more durable and reliable in the field. That actually allowed them to reverse warranty provisions, meaning they didn't even have to spend the money they'd previously set aside for future repairs. All of these factors just perfectly align to lift those margins.
Section 3. Breaking down the revenue. Let's look at exactly where this quarter's $20.6 million in total fuel cell products and services revenue came from. The bus market is still their largest segment at $9.7 million, but other applications are taking a highly significant slice of the pie. Rail accounted for $4.1 million, stationary power came in at $1.8 million, and the segment they call Other Markets, which covers trucks, marine, material handling, and off-road applications, generated a very healthy $5.1 million. This data really humanizes the expanding footprint of hydrogen out in the real world. Check out these triple-digit percentage jumps. Stationary revenue absolutely exploded by 230%, and those other markets skyrocketed by 290% year over year. That massive growth easily offset a 43% drop in rail revenue, which clearly shows their tech is finding rapid adoption in new, diversified heavy-duty sectors.
Section 4. The path to profitability. Their commercial momentum is undeniably surging. When you look at this number, $156.6 million. That represents their total order backlog at the end of the quarter, which is an increase of nearly 39% compared to just the end of Q1. They pulled in over $64 million in new orders this quarter alone, heavily driven by the bus market and a multi-year commitment for 154 fuel cell modules going directly to, you guessed it, GeoPura.
Here is the company's explicit 3-step strategy. Step 1,
Keep executing on the cost reductions that already slashed operating expenses by 34% this quarter. Step 2, successfully complete and integrate the GeoPura acquisition later this year. If they nail those steps, management expects those strategic and commercial synergies to support their ultimate objective, which is achieving profitability by the end of 2027. Now, to remain entirely impartial here, we do have to mention the company's safe harbor statement. Ballard's 2027 profitability target relies heavily on forward-looking assumptions. It assumes the successful closing of the GeoPura deal, which is, of course, still subject to customary closing conditions and regulatory approvals, along with broader assumptions about market adoption. So it's a stated objective, not a guaranteed financial fact just yet. Section 5. Looking ahead to 2026. Because the hydrogen market is still pretty early in its development, Ballard is sticking to past practice and not providing specific revenue or net income guidance for the rest of 2026. They do, however, anticipate revenue to be heavily weighted toward the second half of the year. And they're keeping a tight leash on spending. They're guiding total operating expenses to land between $65 and $75 million, with capital expenditures kept relatively low, around $5 to $10 million. So as they close out Q2 sitting on over $502 million in cash and a business model that's transforming right before our eyes, you really have to ask yourself, is this £275 million leasing pivot the exact catalyst they need to dominate the future of alternative power? Will shifting from selling hardware to providing energy as a service finally secure that long-term profitability by 2027? It is a super bold play in a rapidly evolving market, and we are absolutely going to be watching closely to see how this newly envisioned hydrogen ecosystem plays out. Thanks for joining me for this explainer, and keep learning.